Hello, good evening, and welcome to Gap Trading Strategies. During this webinar, you will get to grips with the basics of gap trading strategies, learn how to apply gap trading strategies to your own trading, participate in a question and answer session at the end of the event. First, I'd like to start the session by giving you some information about me. My name is Ihab Jubil. I was born and raised in Egypt. I have a passion for financial trading as well as teaching. I have been trading for a number of years, mainly on Forex and commodities, and in recent years I have also set up my own signal service and website. I host online webinars and seminars on investment and financial trading regularly, and I provide my service to subscribers worldwide. Now let's start the session on gap trading strategies. Gaps are areas on a chart where the price of a stock or another financial instrument move sharply up or down with little or no trading in between. As a result, the asset chart shows a gap in the normal price pattern. Gaps, also called windows in Japanese candlestick charting. Today I will help you understand how and why gaps happen and how you can use them to make profitable trades. Let's start with gaps basics. A gap happens as a result of underlying fundamental or technical factors. For example, if a company's earnings are much higher than expected, the company's stock may gap up the next day. This means that the stock price opened higher than it closed the day before, thereby leaving a gap. In the forex market, it is not uncommon for a report to generate so much buzz that it widens the bid and ask spread to a point where a significant gap can be seen. Similarly, a stock breaking a new high in the current session may open higher in the next session, thus gapping up for technical reasons. But why are gaps so important? Because it's first trade of the day and market participants must show their hand to buy or sell or to hold, and the opening price action sets tone for session and open creates a high or low price for the day, and because it's utilized by traders of all time frames, long term, swing, and intraday. Remember, gaps are common in the markets. Every day, there is always at least one stock that has gapped up or down when the market opens. Why? As long there is some event happening somewhere between the market close of the previous day to the opening of today, there will be gaps. Even if the markets eventually move little by little toward the 24-hour format, there will always be gaps. After all, somewhere around the world, there is some event happening during the weekends as well. Plus, there is always an excited group of investors who making a big deal out of something or even for no reason unknown to the rest of us. So gaps are a fact of life and there is no avoiding it. The best thing is to take it in stride and learn how to profit from it. Gaps can be classified into four main groups: breakaway gap, common gap, and it's also known as area gap or pattern gap or temporary gap, exhaustion gap, measuring gap, and it's also known as runaway gap or continuation gap. It's all about knowing where the gap is located in the chart and their location in the trend so you can quickly identify what type of gap it is. I will start with the breakaway gap because this one provides the best risk reward ratio. It happens at the beginning of a market move, usually after the security or the instrument has traded in a consolidation pattern, which happens when the price is non-trading within a bounded range. It's referred to as a breakaway gap as the gap moves the market price out of a non-trending pattern into a trending pattern. A strong breakaway gap out of a period of consolidation is considered to be much stronger than a non-gap move out. The gap gives an indication of a large increase in sentiment in the direction of the gap, which will likely last for some time, leading to an extended move. The strength of this gap and the accuracy of its signal can be confirmed by looking at that volume during the gap. The greater the volume out of the gap, the more likely the price will continue in the direction of the gap, also reducing the chances of it being filled, as you can see in the chart. Remember that while the breakaway gap generally doesn't fill like the common gap, it will do in some cases. Also, the gap will often provide support or resistance for that resulting move. Remember also that the breakaway gap is a good sign that the new trend has started. Common gap is also known as area gap, pattern gap, or temporary gap. As its name implies, the common gap happens often in the price movements of the markets. For this reason, it's not as important as the other gap movements, but is still worth nothing. These types of gaps often happen when a market is trading in a range and will often be small in terms of the gap's price movement. They can be a result of commonly happening events such as low volume trading days or after an announcement of a stock split. These gaps often fill quickly, moving back to the pre-gap price range. Here in this chart, another example. Measuring gap is also known as runaway gap or continuation gap. A runaway gap is found around the middle of the trend, usually after the price has already made a strong move. It's a healthy sign that the current trend will continue as it indicates continued and even increasing interest in the direction of the market. After a market has made a strong move, many of the traders that have been on the sideline waiting for a better entry or exit point decide that it may not be coming, and if they wait any longer, they will miss the trade. It's this increased buying or selling that creates the runaway gap and continuation of the trend. Look at another chart. Volume in a runaway gap is not as important as it is for a breakaway gap, but generally should be marked with average volume. If the volume is too extreme, it could signal that the runaway gap is actually an exhaustion gap. I will discuss it further next. which signals the end of a trend. The runaway gap forms support or resistance in the exact same manner as the breakaway gap. Also, the runaway gap does not often fill, and there cause for concern if the price breaks through the support or resistance, as it is a sign that the trend is weakening and could even signal that this is an exhaustion gap and not a runaway gap. It's also called measuring gap because the theory is that the measuring gap will happen in the middle of the move or the trend. And exhaustion gap. This is the last gap that forms at the end of a trend and is a negative sign that the trend is about to reverse. This usually happens at the last thrust of a trend, typically marked with a panic or hype, but can also be the point when weaker market participants start to move in or out of the market. The exhaustion gap usually happens within illogical market philosophy, such as the market being described as a can't miss opportunity or, on the contrary, as something to avoid at all costs. And another chart to identify this as an exhaustion gap or the last large move in the trend. The gap should be marked with a large amount of volume. The strength of the signal is also increased when it happens after the market has already made a big move. Because of the exhaustion gap signals a trend reversal, the gap is expected to fill. After the exhaustion gap, the price will often move sideways before moving against the previous trend. Once the price fills the gap, the pattern is considered to be complete and signals that the trend will reverse. One of the most well-known gap patterns is the island reversal, which is formed by a gap followed by flat trading and then confirmed by another gap in the opposite direction. This pattern is a strong signal of a top or bottom in a trend, indicating a coming shift in the trend. At this chart, an example of an island bottom reversal that happens at the end of a downtrend. It's formed when an exhaustion gap appears in a downtrend followed by a period of flat trading. The pattern is confirmed when an upward breakaway gap forms in the price pattern. The size of the trend reversal or the quality of the signal is dependent on the location of the island in the previous trend. If it happens near the beginning of a trend, then the size of the reversal will likely be less significant. It's quite possible that confusion between measuring gap and exhaustion gap can cause an investor to position himself incorrectly and so miss significant gains during the last half of a major uptrend. Keeping an eye on the volume can help to find the clue between measuring gap and exhaustion gap. Normally, noticeable heavy volume accompanies the arrival of exhaustion. Here are the key things you will want to remember when trading gaps. Once a stock has started to fill the gap, it will rarely stop because there is often no immediate support or resistance. Also, exhaustion gaps and continuation gaps predict the price moving in two different directions. So be sure that you correctly classify the gap you are going to trade. And be sure to watch the volume. High volume should be present in breakaway gaps and in exhaustion gaps. Note that because the forex market is a 24-hour market, gaps in the forex market happens on a chart as large candles. These large candles often happen as a result of the release of a report that causes sharp price movements with little to no liquidity in the forex market. The only visible gaps that could be seen on a chart happen when the market opens after the weekend. There is much psychology behind gaps. Gaps can act as resistance. Once price gaps downward, the gap can act as long-term or even permanent resistance and support. When prices gap upwards, the gap can act as support to prices in the future, either long-term or permanent. The chart shows the gap up acting as support for prices. And as this chart shows many of gaps up and gaps down, notice how gaps down act as areas of resistance and gaps up as areas of support. Remember, you don't have to trade every single gap, but focus on the high probability gaps and also who study the factors behind a gap and correctly identify its type can often trade with a high probability of success. So to request information on my webinars, please go to my website ihabjubail.com. So then I would like to thank you for attending today's webinar. We will hold following webinar soon. So please stay posted on my webpage and binary.com and hope to see you on my next webinar. Goodbye and see you next time.